Hello. You will likely not enjoy this video from a special retard. Don't forget to unlike and unsubscribe so that he may forever live in misfortune, and may nobody ever find this channel. By the way, if you are unsure the message of this video, the message is simple. Crime.
That's right. The message is crime. What's going on, everyone? We're going to look at the, the house of cards, the market we're all in. We're going to look at the life support vehicle that's being used. And you already know what this is. It's the repo market. Now, primer, money market funds and the repo market. Still have questions about the repo? Still wondering how AMC and GameStop and other securities could be relevant to the repo? Buckle up. This video will show you how the way repo historically works compared to how it is changing due to today's situation. The common misconception, common argument I get from a lot of people. In essence, the repo market is life support for the entire market, as essential market functioning is able to continue due to the repo itself. This primer discusses the use of repurchase agreements, or repos as we like to call them, by money market funds and provide a quantitative view of key repo metrics using data from the U.S. Securities and Exchange Commission and the Federal Reserve. The metrics cover historical trends in repo assets and liabilities, repo holdings by money market funds, counterparty types, settlement arrangements, collateral securities, and margining practices. So, repurchase agreement. Repos allow one firm to sell security to another firm with a simultaneous promise to buy the security back at a later date, often the next day at a specified price. The difference between the sale and repurchase price of the security reflects the implied interest rate. The economic effect of this transaction is similar to that of a collateralized loan. The cash investor and a repo receives securities as collateral to protect her or him against the risk that the counterparty is unable to repurchase the securities at the agreed date. The market value of collateral typically exceeds the amount of cash invested in a repo by an agreed upon margin. Now, the economic effect similar they were talking about is that of securities lending. Has the same effect as a repo. It's the swapping of cash for collateral to swap back at a future date. The repo market's size and importance. The repo market plays a key role in facilitating the flow of cash and securities in the financial system. So this is where the life support part comes in. Just look at how much key parts of the market the repo market actually keeps alive. So again, it plays a key role in facilitating the flow of cash and securities. It allows market participants to access low-cost secured financing, to purchase securities, support dealers' market-making activities, and enables leveraged investors such as hedge funds to finance their trading strategies, contributing to price discovery and more efficient allocation of capital. The repo market also offers institutional investors such as asset managers, money market funds, and corporations with undeployed cash balances an option to invest cash on a secured basis. Additionally, repos and reverse repos are often carried out by the Fed Reserve in order to temporarily provide liquidity or to remove liquidity in the financial system to support implementation of their monetary policy and to promote financial stability. However, some argue that the use of repos can lead to over-reliance of financial firms on short-term funding, much like what we see going on today. This paper was written in the first quarter of this year, so not quite to the demand of repo yet. We still had SLR active during that time, so the repo market spiked after this article was published. In addition, the Financial Stability Oversight Council, or the FSOC, has highlighted various risks associated with the repo market and recommends measures to improve the structure and transparency of the repo market and limit potential spillovers from repo-related asset fire sales. Now, the Fed Reserve estimates the total repo liabilities, or repo borrowing, at around $4.1 trillion as of September 30th, 2020. Repo liabilities reached the all-time high at a close to $5.1 trillion in March 2008 and declined sharply during the 2008-2009 financial crisis. Historically, securities dealers have had the largest share of repo liabilities at over 53% of the total on average. So basically, total liabilities declined to 42% as of September 2020. Hedge funds are accounting for 31%, which is significantly higher than the historical average by almost double, because at one point in time, it was only 16% as far as their liabilities. Now, the remaining 27% of the repo, well, yeah, that's the Fed Reserve's program. So the dirty repo I've been reporting on doesn't even cover a third of the total repo market. How about them apples? The Fed Reserve estimates the total repo assets or investments in repos at around $4.6 trillion as of September 30th, 2020. Securities dealers are also the largest investors in the repo market, accounting for close to 28% of the total repo assets. You're not supposed to do that. And that's below the 20-year average of nearly 40%. Securities dealers function as market intermediaries, may explain their large shares of both repo assets and repo liabilities. Dealers exchange cash and securities in the repo market on behalf of their clients and to support their own market activity. It isn't just all in treasuries. Money market funds roll in the repo market. Money market funds participate in the repo market by investing cash in repos alongside other types of firms. As of September 30th, 2020, the financial accounts of the United States show that MMFs accounted for close to 22% of the total repo assets. MMFs do not incur repo liabilities. And let me say it again. MMFs do not incur repo liabilities. That's a good thing. The role of MMFs as cash investors in repos has increased over the last 20 years. One reason for the increase is the growth of assets under management in government money market funds, which are required to invest at least 99.5% of their assets in cash, U.S. government securities, or repos collateralized by cash and government securities. Given the investment restrictions, government money market funds usually invest in a somewhat larger share of their assets in repos than prime money market funds. For example, as of December 31st, 2020, government money market funds allocated over 23% of their total assets to repos, while prime money market funds allocated close to 21% of their assets to repos. Assets in government money market funds more than doubled in 2016 following implementation of the 2014 money market fund reforms and increased considerably once again in the first half of 2020 when demand for government assets surged amidst the COVID-19 pandemic. In March 2020, net assets of government money market funds increased by $838 billion to $3.6 trillion, or up 30% from the end of February. Government money market funds net assets reached nearly $4.0 trillion at the end of April of 2020. Money market funds investments in repos reached an all-time high of nearly $1.6 trillion at the end of March when inflows into government money market funds accelerated. Around 70% of money market fund repos by volume are either overnight or have open terms and can be terminated at any time. 24% have maturities longer than 1 day but less than 7 days, and the remaining 6% feature various other maturity terms. Most money market fund repo investments are executed through a third party that provides settlement and collateral management services and are often referred to as tri-party repos. In contrast, a bilateral repo, each counterparty is responsible in this type of repo for the clearing and settlement of the trade, which makes the repo trading more operationally demanding. Now, what are the counterparties for money market funds? Well, as of December 31st, 2020, money market funds' total investments in repos were close to $1.1 trillion. Money market funds conduct the great majority of the repo investments with securities dealers and primary dealers in particular. Non-dealer counterparties include insurance companies, educational institutions, government-sponsored enterprises, and the Federal Reserve. Some money market fund repos are centrally cleared and novated to the Fixed Income Clearing Corporation. And we're going to go and review the types of counterparties that they have. Number one is securities dealers. And now they're by far the largest repo counterparty for money market funds. Access to money market funds in the repo market facilitates a range of dealers' financing and market-making strategies, indirectly connecting money market funds to a broader set of activity in the financial system. As of December 31st, money market funds held $877 billion of repo investments, or 82% of the total, with securities dealers. Of that amount, $642 billion, repo investments were the primary dealers in Figure 5, which I'm not showing here because it's hard to read. But basically, $642 billion repo investments were the primary dealers. Historically, primary dealers have been by far the largest MMF repo counterparties. Over time, the role of primary dealers has declined and left room for other types of firms to enter repos trading with money market funds. So you see it here. Historically, securities dealers are by far the largest repo counterparties. Historically. Access to MMF and repos indirectly connects money market funds to a broader set of activity in the financial system. That one's for you, old man repo. I know you're in denial. I'm going to keep digging. Now, we also have insurance companies and educational institutions. Investment portfolios of insurance companies and endowments established by educational institutions often hold securities that can be used as collateral to obtain cash in the repo market. Cash can be reinvested to deliver incremental return on a portfolio of securities. Beginning in 2015, a small number of insurance companies and educational institutions established direct repo trading, bypassing dealers. These so-called direct repo trades could offer some advantages, including more flexible terms and potentially better pricing for both sides in the absence of an intermediary. However, this type of repo is often less operationally efficient, which limited its growth. On average, direct repo only accounts for around 0.1% of the total money market fund repo investments. Now, the Federal Reserve. Historically, the Federal Reserve has used repo and reverse repo transactions. You see that? Repo and reverse repo transactions with primary dealers as a tool for monetary policy implementation. I've been told that repo only does reverse repo, or the Fed only does reverse repo. Not the case. This is an article from the Fed. They do both sides. Now, in 2013, the Fed Reserve introduced an overnight reverse repo facility, which is the one we report on a daily basis, which is a new monetary policy tool that was intended to improve control over short-term interest rates and added money market funds as eligible counterparties. Reverse repo provides an opportunity to invest cash on a collateralized basis at a rate set by the Federal Reserve. Currently, RRP operates using only Treasury security collateral and offers a rate of 0.0%. Now, here's where it gets interesting. Since the introduction, RRP has been actively utilized by money market funds, which accounted for more than 80% of the total RRP usage, on average. Money market funds' use of RRP has declined in recent years. In 2020, money market funds only sparsely used reverse repo amid the increased issuance of Treasury bills, which money market funds consider a comparable investment option. Now, what types of repo collateral? Again, they accept a broad range of securities with varying maturities as repo collateral. They're not all Treasury securities. I know that a lot of you tunnel vision like to think that, but things are changing. That's why every paragraph starts with historically in this article. Historically, government securities have accounted for the great majority of MMF repo collateral. As of December 31st, 2020, around 64% of money market fund repo investments were collateralized by Treasury securities, and around 31% were collateralized by government agency securities, including mortgage-backed securities and other things like that. Now, under 5% of money market fund repos were collateralized by other types of securities, including corporate bonds, equities, and asset-backed securities. Equities, keyword there. Among all money market fund types, prime money market funds are the main investors in repos backed by non-government securities. Repos backed by non-government securities. You hear that, old man repo? It happens. Now, while it's only 5% of the time or less, it still happens. And if you look at the grand scale of things, 5% is still a lot when you're looking at the big picture. The great majority of MMF repo collateral securities have maturities exceeding 1 year. Historically, on average, only under 10% of collateral securities were maturing within a year. In a typical repo trade, the market value of the collateral exceeds the principal amount of the repo by a certain margin required by a cash investor. This is what's called your haircut margin rate. The over-collateralization, or haircut, is intended to protect the cash investor from the risk that the value of collateral may decline over the life of the transaction and become insufficient to recover the principal and interest should the counterparty default. Historically, money market funds have required counterparties to provide a margin that depends mainly on the quality of the collateral. For example, the required margin of Treasury securities collateral is typically 2% of the repo principal for a total collateral value of 102% of the repo principal. The margins required by money market funds appear to be tied closely to asset quality, though they change little even during significant market dislocations such as March 2020. Prime money market funds are the main investors in repos backed by non-government securities. Although a small percent on the grand scale, it's a lot, and the proof that it does happen is right there. Now, where to research this? Office of Financial Research is a great website to use. You can see historically how things indeed have been changing. So yeah, is there definitive proof that AMC and GME are being used in repo transactions? No, but is it possible? 100%. That's the point of this video. And to get people thinking that just because something isn't working how it always has been working doesn't mean it's not working how someone else thinks it's working, given the evidence supporting that idea. Anywho, have a good one.